Well, let's go ahead and get started on this session about Keynesian macroeconomics. Most of you probably know that there's an entire host of Keynesian variations. So it's an impossible task, of course, to comment on all these different variations of Keynesian economics. What I would like to do in this lecture this morning is to talk about the economics of Keynes. And this is selected for a couple of reasons. One, unlike other variations of Keynesianism, you've probably never actually heard, unless you've done some reading on your own, I'm sure you've never heard in a classroom at least, what Keynes actually said and argued. And second, by laying out Keynes's theory, it becomes easier to understand the other variations of Keynesianism. It's important in understanding Keynes to realize that when you boil it all down, his economic theory is just a rationalization that he uses. Something like scientific socialism. It's like a rationalization for a particular philosophical view. And in that sense, of course, it's completely immune to rational criticism. You may remember Hayek's lament about not attacking the general theory when it was first published in 1936. And the reason he gave was that, well, when Keynes had published his treatise on money, Hayek had written a long, elaborate refutation of it, and then Keynes just changed his mind. He just said, oh, well, okay, no, this is what I think now. And Hayek was concerned that if he spent years writing a long critique of the general theory, Keynes would just pop up one day and say, I've changed my mind, and here's my new theory. As Dr. Salerno has pointed out in a great article in the RAE on Keynes, Keynes actually developed his thought, his philosophical views developed over time and really culminated with the Great Depression. That was a breaking point for Keynes, where his faith in a regulated, laissez-faire, maybe that's oxymoronic, maybe I shouldn't say it that way, but a regulated market economy was given up, and he adopted a much more rigorous system of regulation. Now, what lied behind Keynes's view of economics is this millennial view of history. So Keynes was a utopian thinker, and more specifically a millennial thinker. And we'll talk more about this on Saturday in the lecture on Marx and Keynes as millennial theorists, but just briefly we can make the point here. Millennial thinkers view history as teleological. That is, history moves toward a definite end from a definite starting point. And the millennial thinker always is the prophet of the final end of history. It claims to know what the final stage of history will be like. For Keynes, this final utopian stage of history was described by the English philosopher G.E. Moore. Keynes was a disciple of. This was a situation where all material needs on the part of people were taken care of by the very slightest of labor. And Keynes believed that this would come about through what we might call a superabundance of capital. So he thought that, eventually the economy would progress to the point where capital existed in such abundance that we would devote very little of our time, our labor time, toward providing for our material ends. And we could devote ourselves to higher ends. And the particular higher end that Keynes had in mind, and this is very important for understanding his economics, is the mental contemplation of objects of beauty and friendship and things of this sort. So what we were all supposed to do is just sit around and think about these wonderful and beautiful things. And you notice the key point about this is that doing such activity does not require any attention whatsoever to economic calculation. This is not a calculative sort of activity, and it's present-oriented, completely present-oriented. No future lookingness about this kind of activity. It's enjoying the present contemplative moment. So here in Keynes we get his extreme present orientation, his hatred toward saving, toward economic calculation, looking into the future and trying to estimate what the benefits and costs will be and so on, of earning money and these other lower sorts of endeavors that human beings engage in. Now, utopia is usually reached through a series of historical epochs or eras. And here, Keynes simply adopted the stage of history view of J.R. Commons. And Commons argued that there was an era of scarcity that existed throughout human history up to about the 15th or 16th century. This was an era of limited liberty, of extensive state intervention. It's virtually no economic progress at all. Then came the era of abundance in the 17th and 18th century, where liberty and laissez-faire unleashed tremendous economic progress. This economic progress for Keynes was a requisite. This is similar to the way Marx thinks about this, right? Capitalism is a requisite to move on to the next stage. So we had to have superabundant productive processes in order to free up our time, to give us the leisure necessary to pursue contemplative ends. So now we're moving into the stage where it becomes possible for a vanguard to be freed from the mundane task of production, to begin to focus on contemplation, and then to begin to reorient everyone's activities toward present goods, these present contemplative ends, and away from thinking about the future, about accumulating capital, about earning money, and things of this sort. So in the era of abundance, we get this paradox or this conflict, I guess, between the vanguard who sees where this history is progressing, and the old guard that's wedded to the old mindset of thinking about calculation and economic activity. So the character of the old character of people is molded to this economic man model, and this actually restricts the development or the movement to the final stage. So we get, again, something like a paradox, right? Capitalism has done great up to this point, but the character that people develop in capitalism prevents the system from moving to the utopian stage. Now, the final stage he called the era of stabilization. And to get to this stage, he even uses this phrase, Commons did, the anarchic forces of production, kind of a Marxian phrase, have to come under political control to provide stability. You'll notice that what these writers are doing is using the Great Depression or the boom-bust cycle as an excuse to implement their own philosophical position. I mean, the argument doesn't really have anything to do with stability, but it's put in this historical context of stability to make it rhetorically powerful, right? So it appeals to people because they say, "Oh, yes, I see now. Capitalism is unstable, and Keynes is telling us how to fix this instability." Okay, so and we'll talk about how Keynes proposes to get stability, so to speak, through the state in this final stage, and then with the state controlling the process of capital accumulation, we can move on to superabundance and enter into the final stage. Now, you notice that this is a very odd point that Keynes is trying to make here. It seems very counterintuitive. He's arguing that capitalism doesn't accumulate capital rapidly enough, that there's something that happens during the process of capitalist progress that stunts it, It does not permit it to proceed into this superabundant state. Okay, so why is that? What argument does Keynes make about this? Well, he says capital accumulation in capitalism depends upon what he calls a double bluff, a double deception. First, he says workers are deceived into producing what they receive little of. So the workers produce the full value of all these goods and the capital and so on, but they just receive wages. They don't get the full value of what they're producing. The capitalists receive, of course, the lion's share of the value of things, Keynes argued, but they can't consume it. What they have to do is plow it back into investment. So all of this wealth that's being produced in the capitalist system, no one enjoys. The laborer doesn't get it. The capitalist gets it but can't consume it. Now he says, why then do people continue to engage in this process of capital accumulation if they don't benefit from it? And he says, well, they do this because saving has been ordained a moral imperative, and it's supported by their religious beliefs. And Keynes, as you may know, was not exactly an orthodox religious thinker, nor was he an orthodox, or we might say conventional moralist, right? So he thought this was absurd. Or to put it differently, he thought that this system of morality and religion was on the verge of collapse because he didn't believe it. He thought it would collapse, and once it collapsed, then this would be exposed for everyone to see, right? If they were doing something stupid against their own interest in saving, simply because they've been instructed by their parents or they had some moral scruples regarding saving and providing for the future and so on. Now, secondly, a second aspect of this is that Keynes also asserted that capital accumulation in and of itself would increase wealth. He didn't think it was necessary, in other words, to have a capitalist process where the entrepreneurs or the capitalist entrepreneurs are allocating capital to the different productive processes according to their anticipations of the profitability in the future of these lines of investment. Right? He thought that just accumulating capital, just having the capital goods, somehow would lead us to this superabundant state, and help usher us into this era of abundance. Now, it should be kept in mind that Keynes is very explicit about this. It's important to recognize what he's really saying here. It's the passages in the general theory where he talks about how under the economic calculation of the market, entrepreneurs would never build up capital that's unprofitable, it's superfluous, or what have you. He talks about, in capitalism we'll have one train line between London and Manchester, not two, because the capitalists would calculate that they wouldn't earn profit on building the second line. He says only the state then can transcend this problem, the limitation of building up capital. The state can just build another rail line, right? What do they care about economic calculation? They can build pyramids. He even uses the example of pyramids. Hey, the state can build pyramids. Private enterprise would never do this. And so really this is an attack on economic calculation itself that he has in mind. He thinks that just accumulating capital goods leads to wealth. He also thought, as all millennial thinkers seem to assert, Keynes thought that the millennium was at hand. It's always just right in the near future. If we're just strong-willed enough to take the necessary steps to move away from the existing order of things, we can move right into the millennial utopia. So all we need is somebody to push us into it. And as I mentioned, he believed that the state, of course, was the way in which this was to be done. That the state could have present-oriented investment, so to speak. They could skew investment projects into those things that capitalists would not invest in. This would require, of course, the control by the state of credit, the elimination, as we'll see later, the elimination of the financial markets, the stock market, the bond market, all those would be out, because these are precisely the manner or the ways in which the entrepreneurs allocate capital, right, through the bond and the stock market. He wanted investment itself to be socialized. so it can be directed by the state, so that all saving and investing would, all saved funds would be invested through the state. And this he put in the context of stabilization. We'll see this. Most of you probably know this already, of how he argues about how this creates stabilization. Right? The business cycle is created by the psychology of the businessmen who overinvest and then underinvest through the cycle. He also believed, like Marshall, that the state needed to control the quantity and quality of the population. Because there might be people who are born that are simply unfit to have their minds altered from this kind of human action, the normal human action calculating mode, into this contemplative utopia that he has in mind. And they would have to be eradicated. He's pretty blunt about this, or at least Marshall's pretty blunt about it. He also believed that in this process, as I mentioned, there had to be a transformation of people's character, and people had to see that it was possible to give up these character traits that they now have, that have so far permitted capitalism to engage in this massive accumulation of capital and the raising of the standards of living of people and so on. So he calls these pseudo-morals. He says there's pseudo-morals that exist in capitalism, like the love of money and saving and inequality and so on, that all have to be overcome. These include economic calculation, working. In the utopia, we won't work. Right? We just sit around and think about our friends and well, you don't even think about your friends. You think about the concept of friendship. And so it's even a little bit more removed from reality than even having fun with your friends. Now, as I mentioned, Keynes gave up the hope that the market would somehow, on its own, or by some limited regulatory state, that the market system itself could move into the utopia by the Great Depression. The Great Depression had a radicalizing effect on Keynes. And so in the general theory, we get a completely different argument, as I alluded to before, than exists in his prior work about what the role of the state needs to be in correcting the instability of the market economy. He comes out in the general theory and simply says that these various character traits, like the desire to hold money, for example, which he calls liquidity preference, are sinful. He equates this with avarice. He equates interest charging with usury, and he comes out against usury. He's in favor, in other words, of banning the credit market. And he calls saving precaution, indicating it's somehow defective or even immoral. Now, he later argues also, and we'll go through these step by step, but he argues also that the source of the evils of liquidity preference and saving, the reason people have money demand and save, is because of the interest, because of what he calls the premium attached to money. And what he wishes to argue then is, or what he wishes to show is that we can only get rid of these sinful predilections on the part of people if we get rid of the interest rate. And we can do this, again, by this more extensive intervention on the part of the state. Central banking to engage in credit expansion to push the rate down, or if that doesn't work, usury laws that just outlaw interest, or even more thoroughgoing is to have the government socialize the credit markets altogether, and eliminate interest in this fashion. So we'll see how he works these arguments out. Okay, so let's start with the first theory that he gives us in the general theory. There are four main theories. The first is what he calls effective demand, or what in more orthodox presentations is sometimes called aggregate demand. But Keynes calls this effective demand. Now, effective demand for Keynes becomes a social manifestation of the present orientation that's necessary to achieve utopia. In other words, remember, one of the problems with capitalism is people are future-oriented. They engage in saving. They save up in order to provide for future ends. What they need is a reorientation of their minds toward present satisfaction. You can't get them to think about contemplating unless you can first reorient their minds, even in the material realm, toward achieving ends immediately or very soon. And so this is why consumption is good, or this is why Keynes needs to make consumption out to be good and saving out to be bad. He's just trying to reorient people's thinking toward present ends. Now, he argues, remember again, he wants to argue this in the context of economics to show that there's instability in the market, right? This rhetorical overlay that he has about his argument. So he argues, of course, in the general theory, and most of us know, I'm assuming you all know this, that present employment and income in the economy depend upon effective demand. Okay, so aggregate demand determines the level of employment and the level of income. Effective demand, in turn, depends upon consumption, which I've already mentioned. Right? This is the spending that people do to satisfy their present ends, and investment. The investment is okay because investment is the present spending done for future ends. Saving is bad because with saving you give up the satisfaction or the aiming at any present end and you aim at a future end. So investment is good, even though it eventually aims at the future. It's good because it has a present manifestation. Right? You're building a capital good, let's say, in the present, and then aiming that toward the future. Okay, now, so how does Keynes? Remember, in standard theory, this isn't even Austrian. It was standard theory that all economists held to be true prior to Keynes. But there's a firm link between saving and investing. In order to engage in investing, if we say that investing is a good thing, in order to engage in investing, we have to reduce our consumption to release the factors of production that we would have used for pursuing these consumptive ends so that we can build the capital, right? It's just, when we save, we're just shifting our production from the production of consumer goods to the production of capital goods. So saving is just that shift, right? Saving is the postponement of consumption that's necessary to make this shift. Now, for Keynes, he has to break this link, right? Because he doesn't want people to save. So he has to break this firm link between saving and investing. So he says, and he does this with effective demand. This is the whole point of the theory. He says that saving is not an activity. Saving is not a choice that people engage in. Saving is just the residual. Saving is just the difference between income and consumption. Right? So when you set up the Keynesian consumption function, right, consumption, we know, is determined in Keynes's theory by what he calls the fundamental psychological law, which seems to me a rather grandiose claim. One might think that a fundamental psychological law would be something, really fundamental, something really important to the psychology of human beings. Maybe Freud has something like a fundamental psychological law. A wrong one, maybe, but it's a law at least we could think of as fundamental. But Keynes's fundamental psychological law is that when income goes up, consumption goes up by a smaller proportion. Now, again, that doesn't really seem either like a law or a fundamental law. But that's his fundamental psychological law. This is the marginal propensity to consume, right? The marginal propensity to consume is between 0 and 1. It's fixed, though. In Keynes' original work, it was a fixed proportion. Okay, so if this is so, then saving is just the residual. See, what people choose to do is consume a proportion of their income or proportion of the increase of their income. The saving is just what's left over. Nobody ever really decides about saving. It's just a passive thing. Now, remember again the Austrian argument here, just to interject. The Austrian argument is that the split between saving and consumption is determined by time preference. So that, you're choosing, in other words, on two margins, we might call it, right? The two elements to the choice. And the choice is made based upon our preference. So when we choose to consume a certain portion of our income, that just means that we've chosen simultaneously to save a certain proportion. We can just look at this choice in two different ways, or as some economists have put it, on two different margins. Okay, so that's the answer or the rebuttal to Keynes' position. Okay, now to get back to Keynes' line of thinking here. So he said that the income and employment are determined by effective demand, and effective demand is consumption and investment. Consumption is determined by income, right, with saving as a residual. Investment, we'll see in his second theory, we'll see that investment is determined by what he calls the marginal efficiency of capital, his second theory. So we'll delay speaking about how investment is determined until then. But what we want to point out here, though, under the heading of effective demand, is that consumption is a fixed and usually in these Keynesian models a large proportion of income. So income itself tends to change based not upon consumption. Remember, consumption is determined by income. Income tends to change when investment changes. And so in a sense, what Keynes is arguing here is that consumers have a certain psychology, this fundamental psychological law, which makes them very stable, and sort of every time income goes up, consumption, you can presume that consumption will go up by the same amount and so on. Investment, on the other hand, is determined by, as we'll see, expectations. And these expectations are wildly variable because there's no basis on which to make them. So again, he's attacking the notion of economic calculation. The future is not really so predictable, or we can't anticipate it very well for various reasons that we'll talk about in a minute. So in order to make income change, investment has to change. And then consumption will just go along with this, right? Consumption will just move as income moves. And this is what permits Keynes to give us his first great innovation. Well, some of these theoretical concepts are innovations in a sense. But his first innovative concept, which is the idea of the multiplier. And the multiplier, as Dr. Salerno points out, is really a master stroke for Keynes. Recall again, the standard theory is that in order to have investment go up, people must save more. Saving is what provides the release of the factors of production for investment to be done, right? And that's what Keynes wishes to refute. He refutes this with this idea of the multiplier. He says, all that's necessary is for investment to increase first. Investment can increase, investment spending can increase without any saving at all, any additional saving. So we increase investment. When we increase investment, income goes up, right? Because income is determined by aggregate spending, by effective demand. When income goes up, then consumption goes up. And saving goes up. And then, when consumption goes up, income goes up again, by a smaller proportion, but it goes up again. When income goes up again, then consumption goes up again, and saving goes up again, by a fixed proportion, right? And this process will repeat itself over and over until saving has increased enough by the increase in income to match the original increase in investment. That's the multiplier. That's the purpose of the multiplier, right? Is to show that all businessmen have to do is throw economic calculation to the wind. Just forget about economic calculation. Forget about having to have a lower interest rate spurred on by more saving in order to engage in these additional investment projects. Just go ahead and engage in the investment project. Just go ahead and do it. And the saving will eventually come through the increase in income that's necessary to finance those investments. You'll just be able to do it later. Or eventually. So this is how he decouples investment from saving. We just have to take a leap. No economic calculation undergirding this investment at all. And things will work out. Now, of course, the problem with this, of course, is that businessmen don't think this way. No businessman would ever do this, right? It goes against his economic calculating mentality. So the only institution that can do this is the state. So his policy conclusion is quite clear. You have to get rid of economic calculation, the entrepreneurs, as the allocators of capital. And you have to vest this in the state, because everybody knows the state can just do what they want, right? They don't have to pay attention to economic calculation. They can be present-oriented. They don't have to worry about the interest rate or other profit and loss elements of their investments or spending. Okay, now the second theory that I mentioned is the marginal efficiency of capital. And this is a theory Keynes uses to give an explanation of how investment is determined in the market. Now, the marginal efficiency of capital is the expected, or what Keynes calls the prospective rate of return on an increment of monetary investment in the current production of capital goods. So, if entrepreneurs make additional investment in various lines of capital, the marginal efficiency of capital is the rate of return they get on that investment. The rate of return on the marginal investment that they make. Now, Keynes argued that it's through this rate of return, it's through the marginal efficiency of capital, that expectations of the future influence the present. So this is the outlet for expectational decisions that are made in the market. Also, he argued that it's this rate of return, the marginal efficiency of capital, that's the price differential across the stages of production. Now, let me once again remind you of what the Austrians argue, we've spoken about earlier in the week. Austrians argue that this price differential in the stages of production, the difference between your input prices and your output prices for the entrepreneur, is the interest rate. It's not the rate of return on capital, it's the rate of interest, right? And the rate of return on various investments in capital that entrepreneurs make is adjusted or conforms to the interest rate by the movement of the capital value, that is the prices of the capital goods. So in various investment lines, let's say for example that we had an investment in some particular line of activity and the rate of return on this investment under current price, the price nexus, was 20%, very high. And so entrepreneurs would form expectations about getting into this business, or if they're in this business, expanding by investing more and so on. They would want to immediately begin projects of investment and to expand, to capture this profit. And just their expectations that they could capture this profit in the future will lead them to intensify their demand for the factors of production today, which raises the costs and moderates the rate of return, right? This manifests itself in the fact that the capital that they're investing in, the prices of the capital goods they're investing in, would go way up. And so you can see how this adjustment takes place in the market, so that these rates of return are actually conforming to the interest rate. This is the Austrian argument. Keynes says, no, this is all wrong. That's not what the interest rate is about. We'll get to what the interest rate is about in the next theory. It's the marginal efficiency of capital alone that is this intertemporal connection between input prices and output prices. Okay, now the marginal efficiency of capital, Keynes thought, was a good thing. In capitalism, this is a good thing. This is what stimulates investment, as we mentioned before. If the MEC rises, then entrepreneurs will invest more, and so that's a good thing. The interest rate, remember, he thinks is related to sinfulness. It's related to future orientation. Later in the theory of liquidity preference, we'll see it's just in Keynes, it's a sop that has to be given to entice people to give up their liquidity. And this demand for liquidity is perverse or even immoral, perhaps. Okay, so now he's established his argument that all expectations work through the marginal efficiency of capital. So now what about the marginal efficiency of capital? What about estimating, in other words, the rate of return on these investments? Well, Keynes says in capitalism this is done very poorly. The basis upon which these expectations are formed is vague and murky, is inadequate, we might say. Now, why is this so? Well, first, the estimates of the rate of return always place, in Keynes's view, an irrational emphasis on the far out future, on the future too far out in time. Whereas we'll see in the last theory that Keynes has that actually he assumes that all all value that's to be acquired in the future will be acquired in a rather short period in the future. So he just assumes that this is irrational emphasis on longer processes. And second, he argues that the knowledge upon which expectations are based is negligible. And because of that, because investors are really not very sure about these rates of return, there are risk premiums that enter into these rates of return, right? They have to have very large rates of return in order to compensate them for what is this impenetrable uncertainty. And so this dampens the number of projects that can be undertaken, right? Whereas they'd undertake more projects if this risk component was not in the calculation. Now, additionally, Keynes argued that in capitalism, this irrational striving for liquidity that people have, liquidity is to hold money, right? The money demand, leads to the emergence of the stock market. So because people want to be able to sell out of their investments immediately and get cash, we have a stock market. And he argues that the stock market actually dampens investment. The stock market is actually counterproductive to investing. And he says, his argument is this. He says if people use their investable funds to buy stock, then they're just buying the stock, right? They're not investing in new production processes. This is funds that they could have used to build a new business or lent to an entrepreneur directly or something like that. They're just buying stock. And so a huge portion of people's investable funds is just siphoned off into this worthless lottery, he called it, of the stock market. Now, clearly here, Keynes just, either was incapable of understanding the role of the stock market in allocating capital, or he just, again, is using a rhetorical device to try to convince us that the stock market doesn't perform the function that all economists outside of the Keynesians argue that it does, which is precisely to allocate capital. Right? The increase in stock prices that comes about from investors buying the stock in one company and, let's say, shifting out of another company is precisely what permits that company's entrepreneurs to raise capital. Right? If they own some of the stock, they've already raised capital just by owning the greater value of the shares of stock that they have. Or they can go into the credit market and borrow against this capital. Or even if they don't do that, other entrepreneurs jump in because these stock prices are anticipations of the future equity or net worth, the future value of the firms that are producing in that industry. So capital flows in there even if the existing firms don't raise capital through the stock market. So again, he seems to just ignore all this. Okay, now another problem with the stock market is once we have a stock market, we have stock prices that are determined by what he called the average expectations of dopey investors. Not professional entrepreneurs who are actually running the firm, but just people like you and me, right? We're just dopey investors. We're not involved in actual production process. We don't really know very much about what profit will be forthcoming in various lines of investment. And the problem with this is that now entrepreneurs, what he calls the professional speculators, right? The professional entrepreneurs have to deal with another level of uncertainty. They have to deal with the uncertainty of the movements of the stock prices, which aren't based on professional estimates or anticipations, but are just based upon investor psychology, optimism and pessimism and so on. So the stock market actually diverts professional entrepreneurs away from the job of estimating the marginal efficiency of capital in their own business towards having to deal with these variations of stock prices. Now, maybe here I'll interject another point of sanity. Again, this is just a standard theory in economics. It's not really unique to the Austrian school, but most economists argue, of course, that the expectations that people form about stock prices, while they can be subject to movements and whims and psychological problems, are in fact grounded on a particular objective reality. And this objective reality is the future equity of the firm. That, after all, is what the stock is a legal claim to, and therefore, while there can be movements in stock prices that don't align with these future expectations. Everyone is aiming at that, right? Everyone is actually aiming at an objective thing. And therefore, it's not exactly as variable as Keynes makes it out to be. Okay, now we can get to his theory of the trade cycle. We can see how this works now. So his theory of the trade cycle is that it depends upon the state of confidence. These investors in the stock market become over-optimistic, or investors at large, even entrepreneurs, and their estimates of the marginal efficiency of capital go up tremendously, and so they begin an investment boom. They're investing rapidly in these projects and so on. And then they have a crisis of confidence. A crisis period comes where they have a crisis in this over-optimism, and they begin to pull in their horns and invest less. And as their investment shrinks, effective demand goes down, and then we go through a negative multiplier process, right? And the economy sinks into recession. So the trade cycle is a phenomena of the psychology of the business world. While consumers are stable and sort of stoic and what have you, businessmen are wild and crazy. Over-optimism, over-pessimism, and that's what sets in motion the cycle. Now, one last thing about financial markets. Keynes not only thought that the stock market then should be abolished or socialized, he thought the same thing about the bond market, because he argued that financial markets actually introduce into the calculation, the economic calculation of the entrepreneur, a new kind of risk. And this sort of risk exists because of the differentiation in the bond market between the saver-lender and the entrepreneur-borrower. These are two different people, right? As opposed to an entrepreneur just plowing his own money back into his firm. And this creates then what Keynes calls the lender risk of default. It's possible then that, in other words, the lender now has to assess the risk of default, which would not have existed, or Keynes argues, or asserts, would not exist if the lender and the borrower were the same person. Now you'll notice that here it seems that Keynes is attacking the very notion of the division of labor. Right? He's saying that all investments must be self-funded to eliminate this risk that exists when we have a differentiation of the lender and the borrower. Now, of course, there are two ways in which this might be done, right? One way would just be to, let's say, outlaw the bond market altogether, so that every project had to be self-invested. The other would be to socialize the bond market, so that the state is the entity that is both saving and investing. And, of course, it's the latter that Keynes favors. Okay, then the third theory is liquidity preference. This is perhaps the most bizarre of all of Keynes's theories. It's the least accepted, even in orthodox Keynesianism. But Keynes actually placed great emphasis on this. His argument here is that liquidity preference, by which he means money demand, well, it's a little bit ambiguous as to what exactly he means. We'll speak about it in a minute, but basically it's best to think of this as money demand. So money demand and the money stock determine the rate of interest. This is Keynes's argument, or his theory of liquidity preference. Again, let me just refresh your memory on what the Austrians say about this, or one might add other schools of thought. Again, it's not particularly unique to the Austrians. But we argue that, of course, that money demand and money supply determine the purchasing power of money, not the interest rate. So that if we, let's say our money demand goes down and we spend more, then our additional spending is on, since money is the general medium of exchange, is on a wide array of goods, which drives prices up. So pushes the purchasing power of money down. Or if the money supply increases, then we have more money that we don't wish to hold, let's say, in our money balance. As we spend it, the prices go up or the purchasing power of money goes down. So this is a more standard approach. And as we talked about in an earlier lecture, the interest rate is determined by time preference in the time market. So time preference determines the supply of and the demand for present money or loanable funds. So the interest rate is not determined by demand for money. It's determined by this fundamental time preference. Now, the reason Keynes the reason Keynes invoked this theory of liquidity preference, of course, is that he could sever the interest in capital accumulation from saving completely, okay? So the standard theory, again, would be that if time preferences go down, people save more, the interest rate goes down, investment goes up. This is a normal process of capital accumulation. For Keynes, remember, if saving increases, then the MPS will rise, the MPC would go down. This would reduce effective demand. If effective demand goes down, then income would fall. Income falls, then consumption and saving go down. When consumption goes down, income goes down again, and we go through a multiple decline in income to the point where the total amount that people saved, even though the proportion of what they saved was greater, the total amount of what they would save would be smaller, what Keynes called the paradox of thrift, which is an implication of the multiplier process. Okay, so Keynes, Keynes has one theory about what happens when saving changes, and now he wishes to, complete this theory about interest and its relationship to investment. Okay, so interest for Keynes is a purely monetary phenomena. It's not grounded in people's preferences. It's rooted in what he calls avarice and precaution. It's determined on a market that's ruled by convention and speculation. And once the interest rate is determined, it confronts this irrationally positioned marginal efficiency of capital. And then it's the interplay between those two that determines the amount of investment, right? So entrepreneurs engage in all projects that have rates of return that they estimate that exceed the rate of interest. Now, another problem with this view is that, like we spoke about before, where Keynes doesn't seem to be able to think on more than one margin at the same time, here he as Dr. Salerno puts it, he bifurcates the decision-making process. He argues this way. He says, first, the MPC determines the proportion of income that's consumed. Okay, that's the first step. And then that leaves the residual proportion of saving that presumably is for future consumption. And then the second step is, of that proportion that's set aside as a residual, liquidity preference determines the proportion reserved into money holding. And then simultaneously determines the amount that goes into securities or debt that actually earns the rate of interest. So that's the sort of bifurcated process he engages in. Now, for those of you who have read Man, Economy, and State, you know that Rothbard has a much more convincing argument which permits a person to make decisions across all margins at once. So he argues that income is split, divided among these three options, right? Consumption expenditures, saving, which then is invested. Saving by definition is always invested. And then changes in money holdings. And so there isn't a decision first to go into consumption and then to divide these two, but a person decides to cross all these margins at the same time, right? On different bases, maybe, but the decision is made across the margins, across all decision elements at the same time. So the split between consumption and saving, as we said before, is determined by time preference. And the money holdings that people have is determined by the subjective value of holding money. I think perhaps you've already had a lecture about demand and supply of money. Yeah, we could one might call it liquidity preference, but we'll see in a minute that it's really not the same. Keynes has a little bit more in mind when he talks about liquidity preference than the Austrians do when they talk about money holding. Because there's some ambiguity in what Keynes means. But yeah, if we wanted to adopt his terminology, it would be fine to call that liquidity preference. Okay, now it's in its next step that Keynes exposes his this confusion that he has, or ambiguity that he has between these two options. Remember, in one sense, he treats these as the same. He says that saving is everything that isn't consumed. And then he tries to divide them according to whether it's simply money holding or interest earning holdings in that category. So there's this ambiguity. And this is exposed when he gets to the argument about why there's liquidity preference. Why do people hold money? And he argues that interest cannot be a return to saving. Here's the ambiguity, right? What does he mean by saving? His argument is that if people hold money, he means cash money, then they earn no interest. So obviously interest is not a return to holding money, to put it in the correct terminology, right? He uses a more ambiguous phrase, saving. So he conflates money demand with saving. And it makes it very difficult to disentangle the whole theory. But anyway, so his argument is, well, there doesn't seem to be any reason for liquidity preference. You don't earn interest. Why do people do it? And this, remember, is where he comes up with his famous 3 motives for holding money or liquidity preference. The transactions motive where people hold money in order to conduct transactions. The precautionary motive where people hold money in order to account for unforeseen future circumstances. And the speculative motive. In the speculative motive, people can, of course, reap a capital gain by holding money and then going in and out of bonds, right? So if they expect future interest rates to go up, that is, bond prices to go down, they can hold money today and then buy the bonds in the future and reap a capital gain. Now, speculative demand for money, Keynes argued, depends obviously then upon the interest rate, whereas transactions and precautionary demand for money depend upon income. And speculative demand can swing. You can have wide movements in this, making the whole market unstable, making the interest rate unstable itself. Now, he also argued that the level of the interest rate, the typical level of the interest rate, and this is similar to his argument about the stock market, is determined by convention. It's determined by this average opinion on the part of people who are in this market. And he further argued that if convention holds that the interest rate is to be at some objective level, let's say that the interest rate should be 5% or something, this interest rate may actually be too high to permit the optimal amount of investment, what he called full employment investing. That the marginal efficiency of capital the estimates of those may not be high enough to compensate those investments for this interest rate that people think won't go down, right? They think it's objectively fixed at 5%. So in a rather conventional kind of expectation formation, then the market would be defective in this sense. It would not permit us to proceed with capital accumulation rapidly enough, simply because people just think that the interest rate has to be 5%. It can't go down to 2, let's say, or 1%. Now, a couple of policy implications here, and then we'll quickly talk about the last of his theories. I want to mention these because they're famous Keynesian constructs. One is the liquidity trap. He talks about expansionary monetary policy. In other words, one way to speed up capital accumulation in capitalism is to have the central bank expand the money supply and push the rate of interest down. But Keynes didn't think that this would work particularly well. For one reason, he thought there could be what he called the liquidity trap. The interest rate may go down to the point where everyone then holds the expectation it will go back up. And if everyone holds the expectation that the interest rate will in the future go back up, they'll hold money, right? The liquidity preference becomes infinite. And so all the additional money that the Fed provides to the market has no effect on the interest rate. People just hold it in anticipation of rising interest rates, falling bond prices in the future. And second, he argues that even if monetary inflation would drive the interest rate to zero, this sort of market rate, this kind of basic underlying interest rate, he says that the effective interest rate is always greater than zero in the market because there's this lender's risk, which we talked about before, which would always persist in the market, and there's also costs of financial intermediation. And so market interest rates could never be pushed to zero, even if the conditions of supply and demand in the money market were such that they would be zero absent from these other causes. Okay, now let's briefly talk about the last last of these four. This is one you probably are not as familiar with if you've had some Keynesian economics. It's called, Keynes calls the scarcity theory of capital. And there are two propositions or assertions that Keynes makes about this. The first is that an asset, a capital good, will yield a value, as have a stream of marginal revenue products, over its lifetime in excess of the purchasing price. Because they're scarce. Because these goods are scarce. To the extent that they're scarce, this will be so. And they're scarce because of the positive rate of interest. Remember, Keynes argued that the problem with capitalism is that capital is still scarce. The capitalist process doesn't accumulate capital to the point where the marginal efficiency of capital is zero. That would be the point at which capital would no longer be scarce, right? There would be no more investable projects that would pan out to profitably. We're talking about the marginal efficiency of capital as estimated by the professional entrepreneur now, the actual marginal efficiency of capital. Capitalism will never accumulate capital to that point because there's a positive rate of interest. So only those projects that have at least a rate of return above the interest rate will be undertaken. Right? That keeps capital scarce. This is what Keynes means by scarce capital. Now, furthermore, he points out that the faster that capital accumulates, the lower the marginal efficiency of capital goes, right? So as capitalism approaches this saturation of capital point, it becomes less profitable to engage in the additional amounts of investment necessary to push the economy into the utopia where the marginal efficiency of capital is zero. You know, at first you get 10% rates of return against a 5% interest, but then it's 8, and then it's 7, and then it's 6, and entrepreneurs have less and less incentive then to engage in these marginal investments. Now, the second proposition that he makes is that there's very little opportunity in the capitalist system for an extension of what he called, and what boehm-bawerk called, the roundaboutness of production. He argued this because he thought that production techniques and production functions were given. There was no new technology, there were no new innovations that would lead to production advances and so on. And so that there was very little scope then in a world like that for intertemporal substitution of inputs. Right? You couldn't lengthen out the structure of production by producing higher order goods as opposed to lower order ones. Okay, so the structure of production, he argued, could only be lengthened if the preference to postpone consumption in the future were strong enough to give us a rate of interest, that is a marginal efficiency of capital, that was negative. And, of course, that would never be done, right? In capitalism, no capitalist, the entrepreneur, would invest with a negative rate of return. Now, here Keynes is clearly just ignoring entirely boehm-bawerk's pioneering work, where he showed that the process of capital accumulation in capitalism is precisely the integration of new technology, of innovations, of inventions, of the discovery of new production methods and so on as capital accumulates. So a firm today wants to, let's say an auto firm, they want to build a new plant facility someplace. They don't just duplicate the plant they were using in 1950. Right? It's new technology that they implement, as long as it's cost effective, they implement into their capital accumulation. And so this notion that the roundaboutness of production in capitalism is fixed, and so the amount of capital accumulation that can be profitably engaged in is fixed, is just empirically, both theoretically, I guess, and empirically wrong. Now, this served another purpose, though, this point that Keynes is making, this assertion that he makes about the limitation of the extent to which capital can be invested in at a positive marginal efficiency of capital. Not only is this a strike against capitalism, Keynes uses this as a point in favor of his own socialized investment, where he says, okay, capitalism we know is stuck now. It's stuck and it won't invest anymore. But because the techniques of production and the roundaboutness of production and the production functions are all fixed, it wouldn't take much for the state to intervene to invest enough to push us to the point where the marginal efficiency of capital is zero, right? There's just not that many more projects that we need to invest in. Capitalism will never do this, but the state certainly can. And so it would only, in Keynes' view, only take a few decades of capital accumulation to lead us into this post-scarcity world. Okay, now one last thing about the scarcity theory of capital. Keynes also posed a thought experiment about capitalism. He said, what if by some magic accident, capitalism actually reached the saturation point for capital investment? What if, in other words, capitalism, just by mistake, by some stroke of luck, entrepreneurs invested to the point where the marginal efficiency of capital were zero? Would capitalism stay at that point? Could it sustain the utopia? And Keynes said, no, it will not sustain the utopia. And it will not sustain the utopia for the following reason. He gives this following kind of argument. He says, first of all, the interest rate will still be above zero. Right? So eventually, the investors will discover that they're suffering losses and perhaps withdraw from these investments. He says, but in addition to that, when the MEC gets to be zero, then investment in the aggregate will be zero. Right? There are no more investable projects that even have a positive rate of return. So investment drops out of effective demand. And effective demand will just be consumption. But if effective demand is just consumption, and the MPC is less than 1, then this is disequilibrium, right? Right? You've overproduced. In other words, you have income levels that are above effective demand. So what happens is, because consumption is less than income, income will shrink. Income always goes to where effective demand is. There's no more investment because marginal efficiency of capital is zero. And so the economy will just spiral downward until it reaches the point where reaches a point where income is consistent with consumption at that level, right? And this could be a very low standard of living.